central and key issue. The second question, of course, is then the implication of this financial crisis for the real economy. I think at this point it's clear that the debate is not anymore on soft versus hard landing for the U.S. economy. We're in a recession, but the debate is on how hard the hard landing is going to be. 6 months ago, the optimists were suggesting this is going to be a short and shallow recession, V-shaped, 6 months, brief fall, and then rapid recovery. I've been arguing for a while this is going to be much more long, protracted, and ugly, something like more like a U-shaped recession lasting 12 to 18 months, maybe even 24. And 6 months ago, the probability of a more severe stagnation, something like an L-shaped stagnation like the one that Japan experienced after the bursting of its real estate and equity bubble in the 90s, was a very low probability. But today we are in a situation in which the V is out of the window. This is not going to be a short and shallow recession. We are already in a recession that's going to be quite severe, and we'll be lucky if it's just a U-shaped lasting 18 to 24 months, unless we really fix the financial system, unless we do right policies. There is a meaningful also risk we're going to end up in a multi-year economic stagnation, something much worse than we've seen in decades. The third question I think is crucial and important is also what is the outlook for the rest of the world, not just for the United States. And here the bad news is while 6 months ago it looked like the United States was the only country that was entering a recession, when you look at the data from the second quarter of this year, so even before the severe financial shocks of September and October hit US, Europe, and other countries, but the numbers from the second quarter of this year suggested that not only the US was entering a recession, but also the entire Eurozone was entering a recession, that the UK was entering a recession, that the rest of Europe was entering a recession, that Japan was beginning to have an economic contraction, that Canada was starting to have a recession. Essentially, about half of all GDP in the world, almost all of the advanced economies, were entering a recession already in the second quarter of this year, before these very severe financial shocks have now reduced confidence, have led to even a worse financial crisis, even a more tight liquidity and credit crunch than before, and therefore going to make the economic contraction more severe. So at this point, we're going to have an advanced economy recession, and the remaining question mark is how much of a slowdown in growth is going to occur in the rest of the world, especially in emerging market economies like the BRICS countries, Brazil, Russia, India, and China. How much of a contraction in growth is going to occur in Asia, in emerging Europe, in Latin America, in Africa. And I think that given the shocks that have occurred in advanced economies, if you look at the channels of transmissions, the idea that the rest of the world could decouple from the United States was far-fetched to begin with, and now with the economic contraction being severe, then trade channels, credit channels, financial channels, commodity channels, currency channels are going to imply a very severe recoupling of economic growth, even in emerging markets economies. Unfortunately, people usually say when the U.S. sneezes, the rest of the world catches the cold, given the financial and trade links. And this time around, the U.S. is not just going to sneeze, it's going to have a severe case of pneumonia or something more severe than that, and therefore the transmission to other countries in terms of financial transmission has already occurred, and the real transmission is going to be also very, very severe. Now, let me say something about the nature of this financial crisis. I think that George Soros gave you an excellent kind of introduction to what happened, and I want just to elaborate on some of the points to just get a sense of what are the key issues. He said that there was a major asset and credit bubble in the U.S. economy, not just the U.S. economy. That's absolutely true. A process of re-leveraging both of the real economy, households, and other institutions, and of the financial system. What led to that? Many factors, but certainly one of them was policy mistakes by the Fed. During the last recession, after the bursting of the dot-com bubble, the Fed aggressively cut the Fed funds rates from 6.5% down to 1% and kept it too low for too long. All the way to 2004, the Fed funds rate was at 1%. So you had easy money, you had easy credit, you had the situation in which investors were essentially underpricing risk, and there was also very lax supervision and regulation of the financial system. These kind of excesses in the financial system would have not occurred if the regulators had not been asleep at the wheel and letting all this toxic underwriting in mortgage and otherwise occurring. They really let it occur because the ideology in Washington for the last few years was one of self-regulation, that means no regulation in financial market, of market discipline, but when there is euphoria and irrational exuberance, there is no market discipline, of reliance on internal risk management models, but as the previous CEO of Citigroup, Chuck Prince, said, when the music is playing, you got to dance, and therefore nowadays caring about the internal risk managers because everybody is investing and taking risk. And then also reliance on rating agencies that were having severe conflicts of interest because they were essentially being paid by those people that were supposed to be rating. So literally it was a system of relying on self-regulation, market discipline, and principle rather than rules that miserably failed. And it's a lesson also about how regulation and supervision should occur. So that was a key element of creating the bubble: easy money, easy credit, underpricing of risk, excessive risk-taking, and no supervision regulation. The other thing I think is important is that in the last 20 years, financial markets in some sense have become less transparent and more opaque. And financial markets work best when people have enough information so they can price different types of risky assets. And I'll give you an example. When you start with a mortgage, and then you convert that mortgage into a mortgage-backed security, and that mortgage-backed security is converted into a CDO, collateralized debt obligation, and that CDO is converted in a CDO of a CDO, and the CDO of a CDO is converted into a CDO of a CDO of a CDO. You have a CDO cubed at the end of the day. You create a financial system in which you have instruments that are new, exotic, complex, illiquid, marked to model rather than marked to market, and rated or better, misrated by the rating agencies. And this is not a system can work. And of course, you cannot do essentially take a bunch of triple B mortgages and through voodoo finance literally convert them into AAA mortgage-backed security. That's impossible. It's literally voodoo finance. And once people realize that was occurring, then people get scared. Because at that point, people become risk-averse because there is no transparency about who's holding the toxic waste and how much of that toxic waste is out there. And therefore, everybody rushes away from risky assets, goes into liquid assets. Literally, it's a financial system in which it's like walking blind on a minefield and you don't know where is the next mine is going to blow up. And therefore, the lesson I think we've learned is that financial systems work best when there is enough information, when people can assess risk, when there is prudential regulation supervision. Otherwise, you create a system that is totally complex, chaotic, and you create the kind of disaster that we have seen. Another element of the financial crisis, I think it has to do with the set of incentives that were created through this system of what's called securitization, exactly transforming initial mortgages or credit card loans or auto loans into complex security. Because in this kind of a system, the other thing was happening was that since there was a risk of, there was a transfer of risk step by step from one investor to another one, nobody was having an incentive to monitor the underlying risks. Think about mortgages. Banks are supposed to be monitoring the quality of the mortgages if they're holding it on their balance sheet. But starting in this securitization food chain with the mortgage broker, the person was maximizing his or her income by maximizing the volume of mortgages approved. He or she did not care whether those were bad mortgages, whether the person didn't have a job or income or assets, whether he could not put a down payment and things like that. So they were maximizing their own fees. Then the bank was originating the mortgage, was transferring it and repackaging into an MBS and making a fee, was not having its own balance sheet. Why would they care about monitoring the quality of the mortgage? Then the investment bank was taking these mortgages and it was repackaging them into CDOs or CDOs cubed, making a fee and transferring it. And in the meanwhile, these securities were being, insured by these monoline insurers. Again, we're making a fee by insuring this stuff, and they were being rated by rating agencies who also were making a fee, and therefore did not care about the quality of underlying assets. So literally you had a securitization food chain in which at every step of the way, somebody was making a fee, nobody was holding the credit risk, and the credit risk was transferred down to the final investor, and of course the final investors were greedy, were searching for yields, they could not anymore price a CDO of a CDO of a CDO, and given that the rating agency were telling you this is AAA, they believed you, and you created this kind of disaster. So when we think about also reforming the system, how we pay bankers or investment bankers, or the way that we give bonuses has to be rethought because the system of incentive is really crucial. Making sure that financial institutions maintain some of that credit risk is important. Otherwise, the incentive is going to be essentially to transfer the risk somewhere down the line and create this huge kind of credit and asset bubble. The other element, I think, of this financial crisis is important is that for the last 20, 30 years, we've had a lot of the financial intermediation occurring outside of the traditional banking system. Banks tend to